Hi, it's Mark Ferguson with InvestFourMore again. Welcome to another video on real estate investing. Today, I want to talk about how to buy an investment property with little money down. Now, there's all types of people out there advertising lots of ways to buy with no money, get started in real estate, make it rich, get all this money without spending any of your own. The truth is, it is possible to do that, but it's highly unlikely to get rich fast without spending any of your own money buying real estate. The less money you spend, the riskier it is, the less returns you will get, and the harder it is to buy really great properties. But I will go through some techniques, some ways to use less of your own money, and to get started in real estate without the typical 20%, 25% down that most banks will require. Alright, start off with, what do banks want? Banks want to see a down payment when they're lending to investors. The reason is they feel investors are riskier than homeowners because they're not living in the property. If they lose a house, it's not as big of a deal to them, and the government gives incentives to people who are owner-occupants who live in houses, so they typically get a smaller down payment to be able to buy a home. Now, because the banks require 20%, sometimes 25% down to buy a rental property, to buy a fix and flip, doesn't mean that's the only way to do it. There are ways to get started with less money, but it will take some work, some creativity, and you may not make as much money as if you're putting more of your own money into it. So the first technique I want to talk about is buying as an owner-occupant. Now, I am not talking about pretending to be an owner-occupant when you're really an investor. I mean actually being an owner-occupant. It is fraud to pretend to be an owner-occupant when you are an investor. Please do not do that. It gives the rest of us investors a bad name and creates more laws, regulations, restrictions on the rest of us. But most banks will require an owner-occupant to live in a house for 1 year. That means when you've satisfied that requirement, when you've lived there for 1 year, you can move out and you can begin renting the home. Now always pay attention to the paperwork you sign. There are some instances where it's more than that or less than that you have to live in the home as an owner-occupant. So one strategy that many investors have used is to buy a house that would be a good rental property, live there for 1 year. After that year is up, they rent the house out, and then they proceed to buy another house as an owner-occupant, use the low down payment again, and repeat the process over and over again. Now, obviously, there are some drawbacks to this scenario. The first one is you have to move a lot. So you got to live there for a year, move out again another year. Sometimes you may have to move even more than that because it's not always easy to qualify for a house right after you've rented a house. So if you live in a house for a year, you move out, you rent it, and you want to buy a new house, most banks won't count that rental income until it shows up on your taxes. So that means you have to qualify for 2 houses at once if you want to use this strategy right away. If you buy a cheap enough house to begin with, then you can definitely do that. Move out, move right back into a new house, repeat the process over and over. The trick is, though, you've got to buy as an owner-occupant and live there as an owner-occupant. You can buy with as little as 3% down with many conventional FHA mortgages. If you can qualify for a VA, you can do it for $0 down payment. Great program, no mortgage insurance. Awesome way to get started if you're a veteran and can qualify for VA. So, one way, owner-occupant. There's many other ways if you don't want to sacrifice moving, the hassle, all of that comes with buying as an owner-occupant, turning it into a rental property. Hard money is another way to buy a rental property with little money down. Hard money lenders are not like typical banks. They are companies that take money from investors and lend that money out to other investors at a higher rate. So they can give you 100% of a deal in some cases. Now normally you've got to be a seasoned investor and have done a lot of deals with them to borrow 100% from them. But even beginners might be able to borrow more than 80%, 90% to get into an investment property. Typically, hard money lenders are lending to fix and flippers because it's a short-term loan. Usually, the maximum term is 1 year on a hard money loan. Hard money lenders will charge a lot. So you will be looking at probably 2 to 5 points on the loan amount. That means you're paying 2 to 5% of the loan amount in fees to that hard money lender. And the interest rates can range from 10% all the way up to 18% for the loan amount that you get from them. Big money. I myself, I have 13 rental properties. I also do fix and flips. I have a local portfolio lender. I do put 20% down. My rates are about 4.5% on my rental properties. On my fix and flips, I put 25% down. It's 5.25%. So 3 times the cost usually with a hard money lender if you go that route. But it is one option to buy with little money down. And that's why I said in the beginning, the less of your own money you put into a deal, the less returns you will get, because the last money you're borrowing on those investment properties gets very expensive. The first 80%, the first 75%, you can usually get a pretty good rate, 5%, maybe 6%. But that last 20%, the last 10%, you're probably going to be paying a lot higher rate. You might be paying mortgage insurance on top of it, greatly reduce your returns and increase your costs. Alright, another way to invest with little money down is private money. Private money is simply money you borrow from somebody else, family member, friend, rich uncle, business associate, to invest in rental properties. So maybe you get a loan for the first 75% of the purchase price, and the down payment and the repairs. You use private money to pay for those. Great way to buy with little money down if you have that source for the money. That's the tricky part, finding the person who will lend you that money. Rates vary widely based on your relationship, the risk, your experience. I borrow private money at 7%, but I'm very experienced, have an awesome track record with that person who lends me that money. They trust me. They know their money is very safe with me. Other private lenders might want 12%. Others maybe 8%. It's all going to be different. Alright, private money, hard money, buying as an owner-occupant. You can also use your current house to try and tap money out to buy investment properties. So you could use a line of credit. Line of credit can be obtained from most banks, mortgage companies, if you have equity in your house. For your personal house, many banks will lend up to 95% of the value. So if you've owned your house for a while, it's appreciated, or you've paid down your mortgage a little bit, you might have equity in your home to get a line of credit, pull out cash to invest in a rental property. Refinance would be another route to go. A refinance is different from a line of credit because you are refinancing the entire loan, plus you're trying to refinance more than what your loan is, so you're taking cash out. A line of credit is just added on to your current loan you have on your home. You can take money out of a line of credit. You can pay back your line of credit. It's called revolving because you can put money in and out the same route. A refinance is a strict mortgage. So you're refinancing it, you're getting a big chunk of money in the beginning. If you pay back that loan, you can't take money back out. You've paid it back. But I used to refinance to buy my first rental property. So my personal house had got a great deal on it. Bought it as a foreclosure. We fixed it up a little. A year after I bought it, it appraised for much more than I bought it for. I was able to refinance it, take $50,000 out, and use some of that money to buy my first rental property. Alright, more options, seller financing. Now again, this is kind of like private money where you've got to find the right people who will do seller financing. It's pretty rare nowadays to find someone who will do the seller financing. Basically, whoever's selling a house, they would sell the house to you, deed it to you, but they would carry the note, they would carry the loan, and they would decide on the terms. They might accept less than 20% down. They might want more than 20% down. All up to them. It has gotten tricky lately with Dodd-Frank. It's a new mortgage regulation act on how seller financing works, how it has to be structured. So be very careful with that. Another option is partnering. So if you don't have any money to flip, you don't have any money to buy a rental property, but you're willing to find the deals, to work on the deals, help sell the deals, get them rented, maybe you find a partner who has the cash and the money to lend you while you're doing the deal. You do the work, they provide the money. A typical split is usually 50-50 in those cases, some more, some less, depending on how the work is divided up. Again, the trick is finding that partner, finding the person with the money, and making sure they trust you. A few other ways, maybe not the best ways, you can use credit cards. It better be a really good deal if you're using your credit cards to buy a rental property or a fix and flip. Really high interest rates, really high payments. Please be careful if you decide to do that. Your IRA or 401k, many people do not realize you can use a self-directed IRA or 401k to buy rental properties. Now, you can also fix and flip with those, but all the money has to go through the IRA or 401k, all the expenses, all the income, all the cash into it, and you can't take that money out until you reach retirement age without severe penalties. Again, talk to an accountant about the details on those, how exactly to do it. On the 401k, you also might be able to borrow money from your 401k if you have a substantial amount in there. Again, please talk to your accountants, retirement experts on those. So I hope those give you an idea of how to buy with little money down. Again, the less money you put into it, the more costs you'll have, the more interest you'll be paying, and the less money you're going to make. But it's a good enough deal, it's an awesome deal, it may be worth it to go that route to get started. Thanks for watching. Again, Mark Ferguson with InvestFourMore. Have a ton more articles on investing at InvestFourMore.com. Thanks a lot. Have a great day.